It wasn't luck, it wasn't genius, it wasn't even corruption. It was structural positioning. Most observers look at the chasm of wealth inequality and see a moral failure. They see greed. They see a rigged game. They are partially correct, but they miss the mechanism. The mechanism is not emotional. It is not political. It is arithmetic, and the arithmetic is merciless. The divide between the ultra-wealthy and the working public is not defined by how hard they work. It is defined by how they interact with the currency itself. One group works for currency. The other group manufactures it. One group saves in a depreciating unit. The other group borrows the unit to acquire appreciating assets. The difference is not in effort. The difference is in the understanding of the ledger. When you look at the last century of financial history, you see the same pattern repeating. A crisis emerges, liquidity dries up. The central authority intervenes, and those positioned correctly absorb the assets of those who are not. This creates a ratchet effect. Wealth concentrates, the middle class hollows out, and the cycle resets for the next turn of the screw. The incentive is clear. If you can borrow at a rate lower than the rate of asset inflation, you are mathematically guaranteed to win. If you hold cash while the supply of cash expands, you are mathematically guaranteed to lose. This is the hidden engine. This is the silent tax. This is the invisible wall that separates the owners from the earners. The pattern is unmistakable. It appears in the bond markets of the 1920s. It appears in the gold markets of the 1970s. It appears in the real estate derivatives of AVA 2008, and current data suggests it is appearing again right now. The scale is different. The speed is different. But the mechanics are identical. This isn't prophecy. It's positioning under constraints. To understand how this mechanism functions, we must strip away the modern jargon of crypto tech stocks and venture capital, and look at the raw machinery of wealth preservation during a systemic contraction. We must look at the moments when the music stopped and observe who had a chair and more. Importantly, who owned the building the chairs were sitting in. Case file. One takes us to the concrete canyons of Lower Manhattan, specifically the late autumn of 1929. The popular narrative of the Great Crash involves panic suicides and sudden ruin. While accurate for the retail speculator, this narrative obscures the calculated movements of the elite capital allocators who exited the building long before the fire started. Consider the actions of Joseph Kennedy. In the Roaring '20s, the market was fueled by leverage. The shoeshine boy and the titan of industry were both buying Radio Corporation of America on margin. The incentive was to participate in the mania. The constraint, however, was the call rate the interest rate brokers charged to lend money for stock purchases. By the summer of 1929, these rates were climbing. The smart money, the capital that understood the plumbing of the system, saw a divergence. Industrial production was slowing, yet stock prices were accelerating. This is a mathematical impossibility in a rational market, but a standard feature of a credit bubble. Kennedy and others, like Bernard Baruch, did not rely on hope. They relied on liquidity analysis. They understood that when everyone is on one side of the boat, the only rational move is to stand on the dock. Kennedy famously exited the market, completely moving into cash and government bonds well before Black Tuesday. But he didn't just sell. He positioned himself to be a liquidity provider when no liquidity existed. When the crash came in October, it wasn't a straight line down. It was a series of violent spasms. On October 24th, Black Thursday, the market cracked. Panic selling overwhelmed the ticker tape. Prices on the floor were significantly lower than what was being reported on the delayed machines across the country. In this chaos, the incentive for the average holder was to sell at any price, to stop the pain. The incentive for the man with cash was to wait. By 1932, the Dow Jones Industrial Average had lost nearly 90% of its value. But here is the key. The assets themselves, the factories, the railroads, the utility grids, had not disappeared. They were still standing. They were still productive. They had simply been repriced in terms of a scarce currency. Kennedy and his cohort, holding cash that had gained immense purchasing power due to deflation, returned to the market. They bought the industrial base of America for pennies on the dollar. This was not a trade. This was a transfer. The middle class, trapping themselves in debt to buy inflated assets, was forced to liquidate those assets at the bottom to service the debt. The wealthy, having exited debt and held liquidity, absorbed those assets. The mechanic. Here is the liquidity trap. When credit contracts, cash is king. When credit expands, assets are king. The secret is not knowing which stock to pick. The secret is knowing where you are in the credit cycle. The outcome of the 1929 crash set the stage for generational dynastic wealth. The families that preserved capital through the deflationary bust of the 1930s emerged as the power brokers of the American century. They didn't just survive. They consolidated. They bought the competition when the competition was insolvent. This consolidation leads to oligopolies, reduced competition, and a political structure that favors the preservation of existing capital over the creation of new capital. Now shift the lens forward to Case File 2, the Great Inflation of the 1970s. The mechanics here are the inverse of 1929, but the result, wealth concentration, is identical. By 1971, the United States was facing a different constraint. The bill for the Vietnam War and the Great Society programs had been paid for by printing dollars. Foreign nations, particularly France, began to doubt the backing of the dollar and demanded their gold. The constraint was the gold reserve. The incentive for the U.S. government was to default on this obligation rather than impose austerity at home. On August 15, 1971, Richard Nixon closed the gold window. The dollar was no longer a claim on a fixed weight of metal. It was a floating abstraction, backed only by faith and tax receipts. The immediate result was a decade of punishing inflation. The cost of living skyrocketed, oil quadrupled. The price of a loaf of bread, a gallon of milk, a new car, everything moved up. For the average saver, this was a catastrophe. A savings account yielding 5% is a losing proposition when inflation is running at 12%. The purchasing power of the middle class was incinerated. They were working harder, earning more nominal dollars, but falling further behind. This is the phenomenon of money illusion. However, for the ultra-wealthy, the 1970s were a period of spectacular opportunity, provided they understood the new rules. The play was no longer cash, as it was in 1929. Cash was trash. The play was debt and hard assets. Consider the Hunt brothers. While their attempt to corner the silver market is often dismissed as a failed speculation, the underlying logic was sound. They recognized that in a fiat currency regime, the government would always choose to print money rather than face a deflationary depression. Therefore, the rational move was to borrow depreciating dollars and use them to buy real things, silver, oil, cattle, farmland. During this period, we saw the rise of the leveraged real estate empire. If you borrowed $1 million in 1972 to buy an apartment complex, and inflation ran it 10% a year for a decade, the real value of your debt was cut in half by the inflation alone. Meanwhile, the nominal value of the property and the rents it generated rose with inflation. You were effectively shorting the dollar and going long on the tangible economy. The transfer mechanism here is the Cantillon effect. When new money is created, it does not enter the economy evenly. It enters through specific channels, usually the banking sector and government contractors. Those closest to the injection point get the money first at its highest purchasing power. They use it to buy assets. By the time the money trickles down to the wage earner, prices have already risen. The wage earner pays the higher prices. The asset owner collects the profits. The 1970s taught the elite a crucial lesson. In a fiat system, being in debt is a feature, not a bug, provided the debt is fixed rate and used to purchase high-quality assets. The inflation that destroys the saver is the same inflation that subsidizes the borrower. The middle class is taught to fear debt. The wealthy are taught to use it as a hedge against currency debasement. Case File 3 brings us to the modern era, the global financial crisis of 2008. This event refined the mechanism of wealth transfer to an industrial scale. The setup was a massive expansion of credit into the housing market fueled by low interest rates and a global savings glut. The constraint was the solvency of the American homeowner. When teaser rates reset and subprime borrowers began to default, the complex web of derivatives built on top of these mortgages began to unravel. The smart money hedge fund managers like John Paulson and institutions like Goldman Sachs saw the cracks in the foundation as early as 2006. They understood that the credit ratings were fiction. They understood that the prices of homes in Las Vegas and Miami were detached from income reality. Their positioning was aggressive. They bought credit default swaps insurance policies against the failure of mortgage bonds. This was an asymmetric bet. The cost of the insurance was low, but the payout if the system collapsed was astronomical. When the collapse arrived in September 2008, liquidity vanished overnight. Lehman Brothers failed. The commercial paper market froze. The global economy stood on the precipice of a second Great Depression. But unlike 1929, the response was not to let the system clear. The response was to flood the system with liquidity. The Federal Reserve, followed by central banks globally, embarked on quantitative easing. They printed trillions of dollars to buy toxic assets from the banks' balance sheets. Here is the key. The bailouts saved the institutions, but they did not save the homeowners. Millions of Americans were foreclosed upon. They lost their equity. They lost their credit ratings. They were forced into the rental market. Who bought the houses? Private equity firms like Blackstone. They entered the market in 2010, 2011, and 2012, buying single-family homes by the thousands at distressed prices. They utilized low interest, institutional credit unavailable to the average person to acquire these assets. The result was a massive shift in the ownership structure of American housing. The middle class moved from owners to renters. The asset class that had been the primary vehicle for middle-class wealth creation was captured by institutional capital. The mechanism here is financial repression combined with moral hazard. The risk was socialized. The public paid for the bailouts, but the profits were privatized. The institutions kept the assets. The low interest rates that followed 2008 punished savers and retirees, forcing them into riskier assets like stocks, defined yield, which further inflated the portfolios of the wealthy. These three case files, 1929, 1970s, 2008, reveal the constraint engine that drives the wealth gap. It is a machine with four primary gears: liquidity, duration, inflation, and political risk. The first gear is liquidity. The wealthy understand that liquidity is cyclical. They hoard cash when assets are expensive and deploy cash when assets are cheap. The public does this opposite, buying at the top due to FOMO, fear of missing out, and selling at the bottom due to panic. The second gear is duration. The wealthy can afford to think in decades. They can hold an asset through a 5-year downturn because they are not forced to sell to pay the rent. The poor and middle class are often forced sellers during crises. They must liquidate their long-term assets to cover short-term liabilities. This time horizon arbitrage is a massive source of alpha for the elite. The third gear is inflation. As we saw in the 1970s, inflation transfers wealth from creditors to debtors. But it also transfers wealth from labor to capital. Wages rarely keep up with asset inflation. If you own the factory, you win. If you work in the factory, you lose. The fourth gear is political risk. This is the most subtle, but perhaps the most powerful. The ultra-wealthy have the resources to lobby for favorable tax treatment, like the carried interest loophole or the step-up in basis, and for bailouts when their bets go wrong. They operate in a heads-I-win, tails-you-lose environment. Mapping this mechanism to the present-day current data suggests we are entering the late stages of another massive cycle. We see record levels of corporate and sovereign debt. We see asset prices, stocks, real estate, art, collectibles at historical highs relative to GDP. We see a disconnect between the financial economy and the real economy that rivals 1929 or 1999. Notice the behavior of the modern elite. We see tech founders selling stock at record paces. We see family offices accumulating farmland, water rights, and gold. We see a move away from paper promises toward tangible, uncounterfeitable assets. They are positioning for a regime change. They are preparing for a world where the 40-year bull market in bonds ends and the cost of capital rises. The counter-argument is often made that these billionaires are simply job creators and that their wealth trickles down. Proponents of this view argue that without the concentration of capital, large-scale innovation like space, travel, or AI development would be impossible. They point to the standard of living increases over the last century as proof that the system works for everyone. While it is true that capitalism has lifted billions out of poverty, the specific mechanisms of monetary distortion, the bailouts, the Cantillon effect, the suppression of interest rates do not create wealth. They redistribute it. When a central bank prints money to buy corporate bonds, it is not creating a new factory or a new technology. It is simply inflating the price of existing assets. The incentive structure today rewards financial engineering stock buybacks, leveraged mergers more than it rewards actual production. Under these constraints, the rational move for a CEO is to strip mine the company for short-term stock gains rather than invest in long-term R&D. This is not a failure of the market. It is a distortion of the market signal by monetary policy. So where does this lead? History suggests three potential endgames. The first is controlled decline. This is the path of financial repression. Governments keep interest rates below the rate of inflation for a decade or more. This slowly erodes the real value of the debt. It is a slow-motion default. The saver bleeds out slowly. The standard of living degrades imperceptibly year over year. We saw this in the post-World War II era, where the U.S. debt-to-GDP ratio was reduced from 120% to 30%, not by paying it off, but by inflating it away. The second outcome is chaotic collapse. This occurs when the bond market vigilantes revolt. They refuse to buy the government's debt at suppressed rates. Yields spike, the currency collapses, hyperinflation ensues. We saw this in Weimar Germany in 1923 and Zimbabwe in 2008. In this scenario, paper wealth is wiped out completely. Only those holding physical assets, foreign currency, or barterable goods survive. Financially, the third outcome is reset and restructure. This is the Bretton Woods scenario. The system becomes so unbalanced that the major powers convene to rewrite the rules. This could involve a return to a gold standard, or more likely the introduction of a central bank digital currency, CBDC, that allows for direct control of the money supply and negative interest rates. We saw this in 1944 and again in 1971. In a reset, existing debts might be jubilated or restructured, and the currency is revalued. Most observers agree that we are currently in the controlled decline phase, with risks tilting toward a reset. The volatility is increasing. The oscillation between inflation and deflation is becoming more violent. The only variable is timing and pain. If you are waiting for a politician to fix this, you will be waiting forever. The incentives are set. The machine is running. The only defense is education and positioning. You do not need billions to apply these principles. You need to understand the difference between an asset and a liability. You need to understand the corrosive power of inflation. You need to reduce your exposure to counterparty risk. Subscribe to this channel to continue analyzing the data without the noise. We do not offer financial advice. We offer financial history and structural analysis. The best time to repair the roof is when the sun is shining. The second best time is now. Prepare yourself. Would you like me to identify visual cues or B-roll suggestions for each of these sections to help illustrate the concepts?